You know, usually when we think about international espionage or high-stakes global warfare, we picture hackers in dark rooms or secret summits or maybe military satellites.
Right, something straight out of a thriller novel.
Exactly. But right now, there is a quiet, ruthless, and just absolutely massive revolution happening right under our noses and the battlefield. It is literally the money in your pocket.
We are watching the fundamental definition of what it means to, pay for something being torn down and rebuilt in real time. I mean, the physical object you hand to a cashier is transforming into a contested digital network.
So welcome to today's deep dive. We have gathered a really fascinating stack of sources for you today. We are pulling from an IMF working paper, insights from a European Central Bank official, economic lectures from UNSW, and payment industry forecasts from Forbes and AV.
Yeah, it's a lot of ground to cover, but it's crucial data.
It is. And our mission today is to completely bypass the usual cryptocurrency hype you see on social media. We're going to unpack the very real three-way battle going on between physical cash, tech billionaires, and global governments.
And how this shadow war will fundamentally change how you buy your groceries, pay your taxes, and, frankly, save for the future.
Right.
To understand where we're going, we actually have to look back at how this all started. The modern digital money era didn't just appear in a vacuum. It was triggered by a sort of perfect storm back in 2008.
Okay, let's unpack this. Because 2008, I mean, most people hear that year and immediately think of the global financial crisis, right?
Well,
Housing market crash, bank bailouts.
yeah, absolutely. That's the headline.
Yeah.
But our research, specifically the economic lectures from UNSW, points to three seemingly unconnected phenomena from that exact year that completely rewired the DNA of money.
Oh, wow. Okay, what were they?
Well, first, in response to the financial crisis, central banks globally slashed interest rates to near zero. That made money incredibly cheap to borrow and move around. Second, Apple had just launched the iPhone, kicking off the smartphone era and making digital connectivity highly mobile. And third, a mysterious white paper was published, introducing Bitcoin.
Which brought in the whole concept of decentralized money.
Exactly. So you have cheap, mobile, and decentralized. That trio of changes suddenly put immense pressure on the traditional physical cash system that we've used for centuries.
Which brings us to a really fascinating vulnerability, because when you look at the underlying mechanics of how cash actually works in society, it's not just about printing paper.
No, not at all. It's an entire ecosystem.
Right, and the IMF researchers modeled this using a two-sided market, meaning for physical cash to survive, you need a critical mass of consumers who want to spend it and a critical mass of merchants who are willing to accept it.
Yeah, and if you disrupt either side of that equation, the whole thing starts to wobble.
Exactly. And what the IMF ran were these numerical simulations to see what happens when a new digital currency enters a market that's dominated by cash.
And the assumption was always that a digital currency would need a massive, coordinated, highly successful launch to actually threaten physical cash. But, and this is wild, the simulations revealed something deeply counterintuitive.
Wait, really? What did they find?
They found that even an unsuccessful attempt by a new digital currency can fatally disrupt the existing cash system.
It makes me think of an invasive species being introduced into a delicate ecosystem. Like, imagine someone brings a new type of aggressive weed into a forest.
Oh, that's a great way to look at it.
Right, because even if that weed eventually dies out because the climate isn't quite right for it to take over entirely while it was alive, it choked out the roots of the native trees, it drained the soil of water.
Yes.
So the invasive species doesn't ultimately survive, but it eats just enough of the traditional ecosystem's resources that the original forest collapses anyway.
That analogy highlights the exact mechanism at play here, because the infrastructure supporting physical cash is incredibly expensive. Think about the manufacturing of ATMs, fleets of armored trucks.
Security personnel, bank tellers, it adds up.
Right. So the moment a new digital payment method peels away just enough merchants who prefer digital convenience and just enough consumers who stop carrying wallets, the per-transaction cost of maintaining that physical cash infrastructure skyrockets.
So it just becomes too expensive for banks and merchants to maintain?
Exactly. Physical cash doesn't get violently overthrown.
Yeah.
It essentially disappears from the market by accident.
And since nature abhors a vacuum, once physical cash started looking vulnerable, the private tech sector didn't just sit back. They saw a $1 trillion opening to become the new underlying plumbing of the global economy.
Yeah, and this is where the narrative shifts from abstract economics to high-stakes power plays. Let's look at the summer of 2021.
Right, the breakfast meeting.
Yes. There was a highly consequential breakfast meeting between U.S. Treasury Secretary Janet Yellen and the Chairman of the Federal Reserve, Jerome Powell. The agenda for that morning was Meta, the parent company of Facebook.
Because they had developed their own private cryptocurrency called Diem. So you have the two most powerful financial figures in America meeting to decide the fate of a private tech company's currency. And going into that meeting, Jerome Powell was actually in favor of letting Meta run a trial, wasn't he?
He was. His logic was that if an American company is going to build a global digital currency, the U.S. government should be in the room to help set the rules of the game. Keep your friends close. Keep your tech giants closer.
But Janet Yellen killed the idea entirely. She absolutely refused to support the trial.
Completely shut it down.
I mean, a trial sounds relatively harmless on paper, but given Meta's global user base across Facebook, Instagram, and WhatsApp, Yellen must have seen that as a Trojan horse, right?
What's fascinating here is Yellen's reasoning, which stems directly from her background as an economics professor. She immediately saw the danger of network externalities.
Meaning what, exactly?
Well, because of network effects, digital platforms inherently create a winner-take-all market. You don't use 3 different social networks for the exact same friend group. You all gravitate to one platform because that's where everyone else is.
Ah, right.
So Yellen understood that Facebook wasn't just asking for a limited experiment. If a third of the planet already has a Meta app on their phone, the adoption rate of Diem wouldn't be gradual. It would be instantaneous global market dominance.
And if a private company suddenly owns the dominant global currency, the risks of tax evasion, money laundering, and illegal trade become completely untetherable from government oversight.
Absolutely. And this really cuts to the core philosophical debate about what money is actually supposed to be. I mean, when Vitalik Buterin created Ethereum, he effectively made digital money programmable.
Fulfilling that old vision from the economist Friedrich Hayek, who argued that we should have competing private currencies rather than a government monopoly on money.
Yes, but history and basic economics tell us that money is naturally a monopoly. We require a single dominant unit of account to function efficiently.
Right, because if you price a sandwich in 5 different fluctuating private currencies, commerce just grinds to a halt.
Exactly. The tension here is about who controls that monopoly. If that power is held by a private tech corporation whose fiduciary duty is to its shareholders, rather than a democratic government whose duty is to its citizens, the systemic risks are unprecedented.
Which means if a private company like Meta controlled the global currency, wouldn't that effectively make an unelected tech CEO more powerful than the Federal Reserve?
Yeah.
Fundamentally stripping economic power away from democratic governments.
That is precisely the realization that sent a shockwave through global governments. They recognized they couldn't just play regulatory whack-a-mole with tech companies forever.
Yeah.
The only way to maintain control over the monetary system and effectively preserve their own sovereignty was to build their own digital weapons.
Which launches us into the counterattack. The Empire Strikes Back. Enter the CBDCs.
Yes. CBDC stands for Central Bank Digital Currency. It is a digital form of sovereign fiat currency. So it's a digital US dollar, a digital euro, a digital yuan.
But the underlying architecture is fundamentally different from the digital dollars currently sitting in your checking account.
Radically different. Physical cash is anonymous and untraceable once it leaves the ATM. A CBDC, depending on how it's designed, is programmable, and it leaves a permanent, centralized digital footprint directly with the central bank.
And we really cannot overstate the scale of this rollout. I was looking at the data from Forbes and AVV. As of late 2024, there are 134 countries currently exploring or developing CBDCs.
That represents 98% of the global economy.
It's massive. The European Union is heavily advancing its digital euro project, with comprehensive regulations expected to hit in the next 18 to 24 months. But the clear frontrunner right now is China.
Oh, by far.
Their ECNY pilot is already nearing $987 billion in transactions, nearly $1 trillion in what is still technically a pilot program.
And the urgency behind this sprint is quite literally a race for global dominance. The U.S. and Europe recognize that if they don't innovate and win this race, they risk losing structural control of international trade.
Because the U.S. dollar risks losing its global reserve currency status.
Exactly. The U.S. currently enjoys what economists call an exorbitant privilege. Because the world relies on the U.S. dollar for international trade and reserves, The U.S. can borrow money at incredibly low rates and run massive deficits without immediate consequence.
Right. But if a foreign digital currency, or even a frictionless private one, replaces the dollar as the global standard, the economic shockwaves for America and its allies would be severe.
Yeah, the privilege vanishes. But to be entirely fair to the central banks, they aren't just building these tools purely out of a desire for control or geopolitical dominance. There are massive, genuine utility benefits to a CBTC.
Like what?
Well, the current global financial plumbing is actually incredibly slow and expensive. If you want to send money overseas right now, it has to bounce through a network of correspondent banks. It takes days to settle, and everybody takes a fee along the way.
Right, it's exhausting.
The CBDC could eradicate settlement delays completely. Transactions would settle in milliseconds, cross-border remittances for the poorest citizens would cost fractions of a cent, and you wouldn't even need a traditional expensive bank account to participate in the economy.
And the efficiency gains for government operations would be wild, too. Like, stimulus checks during a crisis wouldn't need to be printed and mailed or routed through fragmented banking databases. They could be instantly deposited into the digital wallets of every citizen simultaneously.
Exactly, and tax collection could be automated at the point of sale without massive bureaucratic overhead.
But here's where it gets really interesting to me. Upgrading from the current cash and fragmented banking system to a unified CBDC feels a lot like upgrading from riding a horse to driving a modern self-driving car.
Okay, I like that.
Right. Obviously, the car is much faster, it's more efficient, it gets you across the world in ways a horse never could. But it is a car where the manufacturer tracks every single place you drive, records who you have in the passenger seat, and can theoretically lock the doors remotely if they decide they don't approve of your destination.
That captures the exact tension that has economists so divided. Centralized tracking sounds incredibly efficient for stopping money laundering or distributing aid, but it simultaneously reveals exactly why citizens and privacy advocates are terrified of letting go of the old physical cash system.
Because the architecture of a CBDC inherently allows for a level of financial surveillance that is just unprecedented in human history.
Unprecedented.
You see this argument constantly online, though. People say, well, if you don't like government surveillance, just switch entirely to Bitcoin.
Right, the crypto solution.
Yeah, but the economic research we pulled completely dismantles that idea for everyday use. The CEPR source notes it's a terrible monetary anchor, and the Forbes data highlights a 35.48% average annual volatility for Bitcoin.
Yeah, which is worse than gold and global equities.
You simply cannot price a loaf of bread, run a small business, or write a 30-year mortgage in a currency that fluctuates that wildly.
And that volatility points to a deeper structural flaw. The Center for Economic Policy Research notes that because Bitcoin's supply is mathematically capped and rigid, it operates much like the old gold standard.
Meaning it can't adapt.
Exactly. It cannot expand or contract based on the needs of the real economy, which makes it incapable of managing a modern credit cycle or responding to a financial crisis.
So if decentralized crypto is too volatile to be a daily unit of account, and government CBDCs are essentially ultimate surveillance tools, we have to look really closely at the casualty of this war, which is cash.
This raises an important question. What systemic safeguards do we lose if we allow physical cash to die entirely? First, we have to look at inclusion. There are 1.4 billion adults worldwide who still lack access to formal financial services.
Wow. 1.4 billion.
Yes. If you force a complete transition to digital-only payments, you are effectively locking out a massive chunk of humanity from participating in the economy simply because they lack a smartphone or reliable internet access.
And beyond the unbanked, the structural arguments for cash from the CEPR research are fascinating. They point out that cash actually serves as a physical check and balance on central bank power.
Yes, specifically regarding negative interest rates.
Right. It prevents central banks from setting deeply negative interest rates, which economists call the zero lower bound.
To understand the mechanics of that, imagine a severe recession where a central bank decides they need to force people to spend money rather than hoard it. In a purely digital system, they could set interest rates at -5%.
Meaning your bank actually charges you a 5% penalty just for keeping your money in your savings account.
Exactly. But as long as physical cash exists, they can't effectively enforce that. If a bank tries to penalize your savings, you will simply withdraw your money in physical bills and put it in a safe. Cash acts as a physical escape hatch that protects your wealth from aggressive monetary policy.
It's a foundational guarantee of freedom. I mean, it guarantees absolute anonymity, which is a core component of a free society. And crucially, it is the ultimate crisis reserve.
Absolutely.
Think about a regional power grid failure, a catastrophic natural disaster, or a coordinated cyber attack on our banking infrastructure. When the servers go down and the screens go dark, a physical $20 bill is the only payment method that still functions without an internet connection.
And we saw a stark empirical warning of this in our research from UNSW regarding India's 2016 demonetization.
Oh, right. That was wild.
In an aggressive attempt to fight the black economy and tax evasion, the government abruptly removed 86% of the physical currency from circulation overnight.
Literally overnight.
Yes, and the mechanism of execution was deeply flawed, and the result was devastating. It caused massive economic shockwaves, supply chain freezing, and extreme hardship for everyday people who relied on cash to survive.
It is the textbook case study of how not to go cashless. I have to push back a bit on the prevailing economic consensus here, though,
True.
because I understand the theoretical elegance of CBDCs. I get that central banks hate the zero lower bound problem because it limits their toolkit during a recession. And yes, governments want to maximize tax revenue from the black economy, but isn't the total loss of financial privacy and the elimination of a physical backup system during a cyber attack way too high a price for the average citizen to pay just to make a central banker's job more efficient?
You are identifying the exact friction point that is paralyzing policymakers globally right now. The risks at the extreme ends of the spectrum are
Yeah.
simply too massive to swallow all at once. You have wildly volatile, unregulated crypto on one end and hyper-surveilled, fully centralized government digital money on the other. Because these two extremes present such significant drawbacks, the death of cash isn't going to be a sudden cliff edge. We aren't waking up tomorrow to a purely digital dystopia or utopia.
So what are we waking up to?
We are heading into a very complex, messy middle ground.
The hybrid reality.
Exactly.
When we synthesize the payment industry forecast from Forbes and AEV, a full forced replacement of traditional fiat currency is actually highly unlikely in the near term. Instead, the future of your wallet is a hybridized ecosystem. We are going to see physical cash, government CBDCs, and privately issued stablecoins all operating simultaneously.
And to clarify the mechanics there, a stablecoin is fundamentally different from Bitcoin. It is a private cryptocurrency, but its value is permanently pegged to a fiat currency, like the US dollar, and it's usually backed one-to-one by actual reserves.
Which solves the volatility problem.
Right. It allows you to move digital dollars across blockchain networks instantly, without the price fluctuating wildly while the transaction processes.
And even in this hybrid model, the digital side is accelerating at an incredible pace. I mean, global payments revenue is expected to surpass $3 trillion by 2028. Mobile wallets are projected to account for over 50% of all global e-commerce transactions by 2025.
The infrastructure is shifting rapidly beneath our feet.
And the CEPR outlines a truly bold vision for where this technological transition ultimately leads. They discuss this concept of monetary policy on autopilot, an idea originally inspired by the economist Irving Fisher.
Yeah, this is a mind-bending concept, because in our current system, a committee of central bankers meets every few weeks to debate raising or lowering interest rates based on lagging economic indicators.
Right, they look at last month's employment data and try to guess what to do next month.
Which is exactly the opposite of how a digital system would work. In an autopilot system enabled by Web3 technology, money itself becomes a dynamic, indexed unit of account. This relies on what are called smart contracts, self-executing code on a blockchain.
Okay.
These contracts could read real-time inflation data through digital feeds known as oracles. Based on that instantaneous data, the digital currency would automatically adjust its own yield or supply moment to moment.
Wow.
It removes the human element of central banking entirely, creating a self-regulating monetary ecosystem.
Which fundamentally redefines what a central bank even does. And the technological leap making all of this possible is tokenization. We throw that word around, but practically, tokenization means taking real-world assets, whether that's a house, a share of stock, or even your labor, and representing them as programmable tokens on a distributed digital ledger.
If we connect this to the bigger picture, it changes everything. Unlike a traditional bank database, where one institution holds the master copy on their private server, a distributed ledger uses a network of computers to agree on and record transactions, making it simultaneously transparent and incredibly secure.
It blends the established traditional economy with decentralized technology, making the entire financial system programmable.
And what that practically means is the friction of modern finance disappears. You wouldn't need to wait 3 days for a stock trade to settle or pay a massive commission to a broker. The ownership of the asset and the digital payment are swapped simultaneously, governed entirely by the mathematics of the code.
So what does this all mean? For you listening right now, it means it feels like we're moving toward a world where money isn't just one thing anymore. You won't just have dollars or euros in a single bank account.
No, not at all. Depending on the friction of the transaction, you'll reach for a highly specific tool.
Right. You might use a digital euro or a government CBDC for paying your property taxes or receiving a tax refund instantly. You might use a private corporate stablecoin for international online shopping to bypass foreign exchange fees. And you will absolutely want to keep a stack of physical cash securely hidden in a drawer for when the local power grid fails or your Wi-Fi router dies.
The overarching lesson from all these diverse sources is preparation. The future demands a diversified wallet for a deeply fragmented financial world.
To wrap this deep dive up, the critical takeaway is that money is shedding its physical form and evolving into a highly contested, programmable network. And while this overarching transition to a digital-first economy is mathematically and technologically inevitable, actively maintaining your options, specifically keeping the physical cash ecosystem alive, is vital for preserving your own privacy, autonomy, and resilience.
Once you grasp the underlying mechanics of these systems, you really will never look at a banking app, a crypto headline, or the paper bills in your wallet the same way again.
No kidding. And I want to leave you with one final, slightly unnerving thought experiment to mull over, building directly on the discussions of programmable money from the AV and CEPR sources. If a central bank digital currency is inherently programmable by the issuing government, consider what happens during the next major economic downturn.
Yeah, this is where it gets real.
When the government decides they need to stimulate the local economy, they might not just send you a traditional check that you can save for a rainy day. They could issue a digital stimulus payment encoded with a smart contract that is literally programmed to expire and delete itself from your wallet if you don't spend it within 30 days.
The objective being to mathematically force immediate economic velocity completely on their timeline, overriding your ability to save.
Or that exact same digital dollar could be programmed with purchasing restrictions. It could be coded so that the transaction simply fails if you try to spend it on imported goods or carbon-intensive products or certain restricted items. In the very near future, the money in your pocket could come with a mandatory expiration date and a legally binding terms of service agreement.
It's a brave new world.
It really is. So the next time you casually tap your phone to pay for a cup of coffee, ask yourself who is actually setting the terms of your money.
Yeah.
Because that international spy novel we talked about at the beginning, you're not just reading it anymore. You are already a character in it. Thanks for joining us on this deep dive, and keep questioning what's really in your wallet.